Welcome to No Free Lunch, Africa's freshest business and tech podcast, with me, your host, Greg Stewart. And in this episode, we're going to take a look at bonds and where this market is heading in 2026. And my guest today is Conway Williams, Head of Credit at Prescient Investment Management. Welcome to No Free Lunch, Conway.
Hi, Greg, and thanks for having me.
So, Conway, let's first off ask you to define what is a bond and why is this a key investment debt raising facility in modern financing?
So I think the simple answer, and if I break it down, what we do is we lend money to corporates, to state-owned entities, to mining companies and the likes. So think of it as we are a glorified bank and you approach us for a home loan or a car finance or anything along those lines. Then between you and I, we decide on what the terms are going to be of that finance, whether it's a short-term 1-year opportunity, a 3, 5, 7-year that I'm going to lend it to you, a 10, 15, 20-year opportunity, because you need to do refurbishments on your house, buy a new house, buy a car, as I said. We just obviously do it at scale, and we do it for large-scale opportunities, whether it is infrastructure, whether it is for roads, whether it is for you to go buy another or buy a competitor and the like. So we provide financing to anybody and everybody over certain thresholds with predefined criteria. And then we have a lending relationship for that entire period. Why it's so important in modern finance? Again, the reality is the world is built on debt. The world is built on people being able to access finance, being able to access equity. And again, if you don't want to give up your share of your business and sell equity, you're going to approach a bank or a financier to obtain debt on terms that you can actually repay and obligations that you can honor over time.
So most people are familiar with the bonds on bonded properties, for instance. You get a bond for your
Yes.
house. These financial bonds are often issued by governments, large corporations like the ESCOMs and so on. What's the difference between a bond and a loan?
I think it's for all intents and purposes, it's the same thing, right? Because you have an obligation, whether it is to pay your interest quarterly or monthly or yearly. It's the same thing when it comes from an obligation perspective. I think the difference between a bond and a loan, or where we operate in the debt capital markets in terms of issuance under domestic medium-term note programs, is who the actual issuer is and who the buyer is. Bonds are issued by government. I think the name is self-explanatory. It is issued for various purposes, mostly, again, just to fund the country's needs. Whereas debt issued by a corporate, think of it being a Pick and Pay or an Omnia or a Mercedes-Benz, they actually have needs, financing needs, whether it is to put up another factory in Roslyn or to buy a DC and operate a DC. Those are, again, issued by a corporate or a state-owned enterprise and sold to the actual asset management or banking space. So the man on the street can't buy a bond that's issued by a Pick and Pay for corporate purposes, other than if that person invests with an asset manager and then we act on behalf. But again, the way it operates, the way it reprices, the way it actually, from an obligation perspective, it is very, very similar.
Yeah, except bonds tend to be large sums of money and
Yes,
repayment terms are normally over a longer period of time,
longer period of time.
which
Yes. Yeah.
provides, for some investors, provides them with a more stable outlook for a return. And so people who invest in bonds will generally look for a longer term stable return on their investment. Just in terms of some of the comments you've made on the current marketplace, you've said that corporate credit is now priced for perfection, leaving investors with very little margin for error. Do you want to actually unpack that for us a bit and explain what you mean by that?
So I think what we've seen through our analysis is that there's a very low margin of safety when it comes to the return that you earn on a bond versus the actual risks embedded in the bond. And I think we always look at return and risk at the exact same time in the exact same manner. So at this point in time, we've seen the market actually, there's such a large demand for corporate credit and a very limited supply thereof. I can go into the details in terms of why we think that is the case. But when you've got limited supply and excess demand, price just goes down. And it's been a recurring theme for the last couple of years, if not for the last decade, where spreads, which is that additional margin that you earn for buying corporate credit, continue to actually trend downwards. So if I just take one step back, remember when you're buying a government bond, it is considered, and I say this in inverted commas, risk-free because you're lending to the government. There is an embedded understanding that government can print money, etc., etc. But when you are playing in the debt capital market space where there's a corporate that's actually borrowing, they need to actually be paying a premium over risk-free. And that is the spread component that you earn. That is for consideration of if they default, consideration of expected losses, the fact that these bonds aren't as liquid as government bonds, there has to be some sort of premium that they are earning, and that's the spread. But now that spread has come down considerably, and in 2025, it was a meaningful contraction across risk classes, whether it is your bank senior all the way to your additional tier one type instruments. That spread continues to trend downwards, which means now that your accrual that you are earning or the return that you are earning is a bit less, not necessarily in real perspective, but just that spread has come down, that compensation over Gavi. And again, like I said, price per perfection means that now if there is a default or a risk, all of those additional risk premium that you need to be actually be pricing into it, whether it is illiquidity of these instruments compared to Gavi, there's less and less room. And again, that it's driven by, I guess, like I said, people and flows into our market from an FI or fixed interest perspective. That has meant that investors, whether it's myself or my competitors, are all out looking for opportunities with limited opportunities, limited growth in the market from a GDP perspective, limited mergers and acquisitions or actual capex opportunities that there were over the last 3 to 5 years, if not the last 10 years, that has now resulted in this pricing for perfection. So it's just literally about everything is priced in. And when everything is priced in, you know that not all risks are being considered and people are chasing yield at any cost. And that is why you need to be very careful when it comes to credit these days.
So, explain how your bond market works. Do you take investors' money and invest it in those bonds, or are you simply raising capital in terms of creating returns for Prescient?
No, so we are an asset manager. We act on behalf of client and client funds. So what we would do is we've got retail clients and we've got institutional clients who will trust their life savings with us, of which we then have a defined mandate. So for example, we would have a cash mandate or an income mandate or an equity mandate or a multi-asset mandate. And then per your risk consideration, we'd invest accordingly. So then with regards to the
And
debt
tell me,
capital.
continue.
Okay. Then again, where we fit in, or my team and the broader fixed interest team is we invest in the fixed interest market. So as you said, it is the market that where you're buying bonds, you're buying credit or credit type instruments. We investing, as you said, we are a lender in that regard. And then we have borrowers that we have interactions with. So that is what we do in terms of Prescient and deploying money on behalf of clients.
So the bond market has become a bit of a tricky setup currently in the marketplace, as you mentioned, with liquidity changes and not so many bonds available in the marketplace. What are the reasons driving that situation? Are there the corporates simply not getting into more debt, or is there because of the lower growth rate? What are the drivers of that situation?
I think it's all of those in varying degrees. I think the starting point is that there's just been such a significant inflow into our market from clients for fixed interest instruments, which, as I said, then creates that demand for it. So remember, if you are buying an equity instrument and you get a dividend yield of say 6 to 8%, and then you are thinking in a normalized environment, capital growth of 5 to 10%. For buying an equity or a risk equity instrument, you are earning that 7% divi yield plus a little bit of capital. So you're working 12 to 15%, right? If you are buying what we are actually investing in, we're looking at senior opportunities, which is, again, from a risk perspective, a better risk than buying. So obviously, you'd get a lower expected return. But again, our lower expected return is 10, 11, 12%. So why would we want to be investing in equities at 15, where you can lose all of your money, or you can invest in debt at 10 to 12%? Again, so that has driven quite a bit of things. Also, our government bond market has had a stellar run over the last couple of years. Yes, there's been interim volatility, but we had a stellar, for example, 2025. So again, when bonds are doing roughly 20 to 30 odd percent, and you've got equities doing 30 to 40, where you're going to be want to be playing on a risk adjusted basis, or there's going to be an allocation across the two. And that has been that demand factor because of the inflows. The second one is also just on the issuance levels. So we've had, over the last 5 years, we've had municipalities and SOEs actually staying away from the market, which has again been driven by a host of reasons. For example, people weren't necessarily trusting whether SOEs and the likes could do what they were supposed to be doing. But now we're seeing a marked improvement, and hopefully that will drive sort of activity again going into 2026, which we are very excited about. But then another point that you raised, that is it a GDP sort of issue? Is it a de-risking issue? It's again both of those, because we have muted growth, right? So if there's muted growth, then why would people be wanting to invest in capex plants and the likes? That is very important. Then also, if you've got a risk environment and we're not knowing what's going on, or there's volatility, or the regimes are not actually as consistent as you want, why are you going to want to deploy money, and probably expensive money? So it's a host of
Yes.
available opportunities because of the environment. Yes, we get that. But in the stellar amount of actual flows into our space, supply demand mismatch continues. It's a structural imbalance, as you would call it.
So Eskom, and in particular, I think is facing quite a large bond maturity rate
Yes.
this year, in fact, and that should bring some liquidity back into the marketplace.
Yeah.
But
Yes.
there's also credit risk involved with that, isn't there?
Yeah. So I think if you take a couple of steps back, if we look at where Eskom and Transnet is now compared to where they were a couple of years ago, there's been a marked improvement in both. We're not saying things are perfect. We're not saying things are where it should be, but there's a marked improvement. Now, if I just take, and I know you're asking about Eskom, but if I just go to Transnet for 1 second, they had one of the largest, if not the largest, auction ever. They wanted to issue 5 billion rand. They got bids of 42 billion rand for that auction. So again, we've seen demand return for SOEs, state-owned entities, in a way that there wasn't a couple of years ago. One, it's because we're seeing improvements from Operation Vulindlela. We're seeing corruption issues being actually considered. Again, transit and logistics is becoming an improving environment. Eskom was in a very similar position a couple of years ago, but now they're reporting better results. There's again the transmission that's actually being discussed appropriately. They've got an improving governance sort of backdrop as well. So their ability to raise capital has improved. And again, the 38 billion is a massive amount that needs to be redeemed this year. It's one of the key drivers of, I suppose, market issuance this year. And I think they are in a better standing to raise that. Now, the question then becomes is, do they need government support, and do they need a government guarantee to do that? And I think that's the question that's going to be on everyone's lips. If we look at that 42 billion rand facility that Eskom was able to raise, it did actually come with a government. I'm Transnet, sorry, it did come with a government guarantee. So there will still be fiscal support required for both, but in which degree and which extent, that is going to be the question. But again, I'm seeing, or from our analysis, is an improving situation.
Yeah, at least with Eskom, they're starting to show improvements on their bottom line,
Yes,
and that should
considerably.
perhaps relieve to a certain extent the requirement for government support on those bonds, and that's probably a good thing. Although the rates increases might be risking their business income going forward, so that's quite an interesting scenario that's going to play out. Let's just talk a bit about the international bond market. And I know that's not particularly your purview, but in the international bond market, there's been some interesting things happening. For instance, the yields on the Japanese bonds, government bonds, have reached highs of, I think the last I saw it was something like 17-year high on the yields, and at the same
Yeah.
time the yields on the American bonds are going down, and there's this pressure of bonds and repatriation of debt back into Japanese bonds from Japan, and that seems to bring up
Yeah.
all sorts of risk for dollar stability, for bond stability, and even in Japan, with their currency now gaining strength because of this. Yeah, just chat to us a bit about that and what you think might be happening in that market.
So, firstly, I'm not the subject matter expert. I can call my colleague Riza Ishmael, and he can talk to you for days about it. But just a summary view is that we are seeing global volatility, and I think we have to understand that. I think the JGB's yields actually have reached massively elevated levels over the last, I suppose, 2, 3 months. I think it reached about just under 2.3% a couple of days ago. So it's a substantial
Yeah.
increase compared to historic levels. We have to just acknowledge that. And whether that is because of policy uncertainty, political uncertainty in Japan, fiscal expansion in Japan, or just policy normalization, it's a host of factors that we can talk about. As I said, Riza would love to speak to you about that. But I think the impact of an elevated Japanese yield trade is that it will have a global impact and it will have impact on currency volatility. And that is something that we are going to watch. There's going to be ripple effects. We're going to see how it's going to impact Europe. We're going to see how it's going to impact the States, the dollar, and then ultimately how it will impact our local market. But again, volatility, whether it is long term or short term, does impact yields. And I think it's an interesting trade to watch because I think, yeah, Japan is an interesting place. They've got there's a lot happening there. And I said, as I mentioned, policy normalization and also policy and political uncertainty. There's going to be an interesting trade there that could happen. Then when talking about
Yeah,
the
and
US and the impact locally,
Japan,
that is a more interesting one.
yeah. Japan certainly is sitting with, I think, one of the highest national debt globally, in fact. And so there's all sorts of volatility that seems to be building into that market. But as you mentioned, what impact does that have locally? And it's certainly going to have to be I think, a carefully managed market here, although the rand is showing certain
Strength.
very good strength and stability. And it dipped below, I think it dipped below $16 to the 16 rand to the dollar this
Yesterday.
morning at some point, and looks to be heading down to below the 16 rand mark per dollar, and that would show that certainly there's stability. Of course, there's the concerns about weak economic growth and so on. But you certainly are going to have a complex market. And how does that affect the local bonds? Do you see some major shifts happening at this side?
So I think just to go back to your point, yeah, Japan, one of the highest debt to GDP ratios in the world. I think it's now well in excess of 210%. It's crazy. So that policy normalization is going to, as I said, have an impact not only in the Japanese and the Asian markets, but then also, again, if you go to the more developed and emerging market worlds from a currency volatility perspective, it's going to be crazy. On your question on the impact on the local debt capital markets, I think the starting point is that our debt capital markets, and if I just exclude government bonds for 1 second, is largely an South African investor market. We don't see that many international players purchasing debt capital market debt. So I think that's the important part. And again, when things were going crazy in the market, various, I would say, crises or what we'd call black swan events, whether there was changes to government policy and the likes, we continue seeing the structural imbalance impacting spreads over economic fundamentals impacting spreads. So to say that in a more simplified manner, spreads continue to do this, even though things do that. Things are getting worse, things are getting better. It doesn't matter which way the economics are looking, we are seeing spreads trade downwards. And that is why, if I go back to the very, very first point, this price for perfection market, we should actually see spreads following how risk. So if risk is increasing, spreads should go up. But we're not necessarily seeing that because of the demand supply structural imbalance that we are seeing. And that is the important part here. If it were a lot more international players in this market, I think it would be a little bit different. So I'm not too concerned about the international market. Where I'm more concerned is if we are funding corporates that have offshore revenue streams. because that will be impacted by the currencies, positively and negatively. Because ultimately, cash is king. How we get repaid is how a company sells its product or service, pays for its operational expenditure, and then has its obligation that it needs to be repaid in terms of how I finance it. If you are in the States right now, can you actually operate? If you are in Middle Europe or Eastern Europe, can you operate? Can you repatriate those cash flows from Africa? Those are the type of things that we considered, especially in a world that is not playing by, I think what's the Canadian PM said, that the current world order is not as it is or it should be or how it always operated. So again, a lot of uncertainty when it comes to that. So that is the part that we also were mentioning in the article. It's not only about the spreads or the return, but ultimately how you look at risk. If you're not looking at risk right now, you are fighting a game that you are going to lose. You actually have to be selective in terms of your credit. You have to make sure that you do the work, not only in terms of deploying capital, but then also monitoring. And if you don't know and you don't do that, you are going to face problems in your portfolio. So that is very important for us to make sure we defensively positioned at present, but again, the opportunities within that we can still deploy our capital and make sure that we take care of client needs.
Conway, I really appreciate your insights, and we've run out of time here, but thank you for your insights and your inputs, and hopefully we get to talk to you a bit about the interesting world of bond investments going forward. Conway Williams, thank you for your time.
Thank you very much.